Hey everyone, welcome back, and if you are new here, welcome. Before we start, thank you. This channel is growing because of you. Every view, every comment, every subscribe, I do not take that for granted. Now, what I am about to show you is something almost nobody is talking about. Let's get into it. Something changed in March 2026, and most people have no idea it happened. Banks across America quietly received new authority to freeze, delay, and hold your money before it ever reaches the person you're sending it to. Not because you did anything wrong, because an algorithm decided your transfer looked suspicious. Here's what happened and why it matters to anyone with a bank account. On March 20th, 2026, a new set of rules from NACHA went into effect. NACHA is the organization that governs the ACH network, the system behind direct deposits, bill payments, Zelle transfers, payroll, and virtually every electronic money movement between banks. The new rules require every financial institution and every business that processes electronic payments to implement what NACHA calls risk-based fraud monitoring on all outgoing transactions. In plain English, your bank now runs a behavioral analysis on your transfer before releasing it. Not just wires, not just large amounts, every ACH transaction. If the algorithm detects anything that deviates from your normal pattern, a new recipient, a different amount, an unusual time of day, it can pause the transfer for manual review. These pauses can last anywhere from a few minutes to a full business day. In some cases, much longer. And here's the part that affects everyone. The threshold for what counts as unusual has dropped dramatically. Transfers as low as $600 are now being flagged, delayed, or held for review. Not because $600 is a suspicious amount, but because scammers typically instruct victims to send between $600 and $2,000. So regulators told banks to monitor that range more aggressively. That means if you send $650 to a contractor, or pay a family member back for a shared expense, or move money between your own accounts at different banks, the system may freeze it first and ask questions later. Banks are now required to compare every transfer against your historical patterns. The amount, the frequency, the destination, even the device you are using. If anything looks out of character, even if it is perfectly legitimate, an automated review is triggered. And this is not just one set of rules. It is coming from multiple directions at once. A second phase of NACHA rules goes into effect on June 22nd, 2026. Phase 1 in March covered the largest banks, those processing 6 million or more ACH transactions. Phase 2 covers everyone else, every community bank, every credit union, every small town institution. All of them must have fraud detection running on every outgoing payment by summer. The Federal Reserve Bank of Atlanta called these rules potentially a breakthrough in fighting authorized payment scams. But the word that matters is authorized. These are transactions where the real account holder is the one pressing send. The bank's job now is to decide whether you really meant to do what you just told it to do, and the tools are getting more aggressive by the month. In January 2026, regulators introduced what they call the speed bump rule, related to FINRA Rule 2166 proposals. This gives financial institutions the power to place a temporary hold of up to 5 business days on any transaction they suspect is fraudulent. 5 business days. That is a full week of no access to your own money. Under the old system, a phone call could clear up a flagged transaction in minutes. Under the new rules, many holds require a formal internal review. The customer cannot override it. The bank decides when to release the funds. More than 30 states have also enacted what are called safe harbor laws. These laws give banks legal immunity when they freeze a transaction they believe may involve fraud or exploitation. The American Bankers Association reported that nearly 60% of bankers now feel confident they will not be sued for freezing a legitimate transfer. That is a critical shift. It means the risk calculation for your bank has completely flipped. Before these laws, banks were cautious about freezing accounts because they feared lawsuits for wrongfully blocking access to funds. Now they have legal protection. So the incentive is reversed. It is safer for the bank to freeze first and investigate later than to let a transfer go through and face regulatory consequences. And the tools they are using to make these decisions are not human. They are artificial intelligence systems. Banks have deployed AI monitoring platforms that track behavioral patterns at scale. These systems look at how you type, what device you're using, what time you log in, whether you were on a phone call during the transaction, and how quickly you move through the screens. One platform specifically designed for monitoring seniors tracks risk factors unique to older adults. If the system detects that you're logged into your bank app while on a phone call, which is a common pattern in tech support scams, it can flag the transfer as high risk. If you're typing with hesitation, which the AI interprets as someone being coached by a scammer, the system may block the transfer entirely. This technology has caught fraudulent transactions worth tens of thousands of dollars, but it also generates what the industry calls false positives. And for the people caught in those false positives, the consequences are real. In early 2026, thousands of customers reported losing access to anywhere from $3,500 to $10,000 for up to 2 weeks at a time. Not because of fraud, because the algorithm misread a routine transfer. A grandparent sending $2,000 to help a grandchild with tuition. A retiree wiring money for a legitimate home repair. A couple transferring money between their own accounts, all frozen, all waiting for manual review that takes days. For someone on a fixed income, a 2-week freeze is not an inconvenience. It is a crisis. Bills bounce, prescriptions go unfilled, rent goes unpaid. And it is not just algorithmic errors. Banks are also freezing accounts for documentation reasons. Know Your Customer regulations, KYC, are being enforced more aggressively across the entire banking system. Banks are auditing older accounts that may have been opened decades ago with minimal documentation. If your file is missing a current government-issued photo ID or proof of address, the system can automatically place a soft freeze on the account until you update it. You might not even know the freeze is coming. Many customers only discover it when their debit card is declined at a register or their automatic bill payment bounces. Multiple major banks have also faced scrutiny for freezing accounts of customers who could not produce updated citizenship or residency documents, even when those customers were legal residents or naturalized citizens who had banked with the institution for years. In several reported cases, account holders were locked out for days or weeks because the bank flagged their documentation as incomplete. The bank said they were following standard compliance procedures. Advocacy groups said the procedures were being applied too broadly. Meanwhile, the physical banking options are disappearing at the same time. Major banks have been converting branches into what they call advisory centers. These locations often have no teller line and limited cash on hand. To make a large withdrawal or get a cashier's check, many banks now require a scheduled appointment days in advance. ATM withdrawal limits are typically capped at $500 per day. So if you need $3,000 for an emergency and your transfer is frozen, you cannot just walk into a branch and withdraw the cash. The digital infrastructure is also creating barriers. If you try to log into your bank account from an unfamiliar device, a hospital tablet, a hotel computer, a relative's phone, the system triggers a lockout. Because the device fingerprint does not match, the bank assumes it is an unauthorized access attempt, and the old security questions have been phased out as obsolete. If you do not have your registered phone to receive the verification code, you are locked out completely. Now, here is where this connects to tax enforcement. The IRS has always had the power to freeze bank accounts to collect unpaid taxes. That has not changed. What has changed is the speed and automation of the process. When the IRS issues a bank levy, the bank immediately freezes the funds up to the amount of the tax debt. The account holder has 21 days before the bank sends the money to the IRS. During that 21-day window, the account holder cannot withdraw, transfer, or use the frozen funds, and the IRS does not need a court order to do this. It only needs to have sent a series of notices, typically 4 or more, and a final notice of intent to levy at least 30 days before the freeze. Most people who get hit by an IRS levy say it came as a surprise, but the IRS says they sent multiple letters first. The problem is that many people ignore those letters, or mistake them for junk mail. By the time the levy hits, the window to act has already passed. Here is what many people miss. The IRS freeze only applies to funds in the account at the moment the levy arrives. New deposits are not affected by that specific levy. However, the IRS can issue additional levies on future deposits, and unlike a wage garnishment which attaches continuously, a bank levy is a one-time snapshot. But the IRS can take that snapshot as many times as it wants. The IRS has also received significant new funding to upgrade its enforcement capabilities. Its systems now cross-reference bank account activity against reported income more efficiently than ever before. So the picture that emerges is this. On one side, banks are freezing transfers more aggressively than ever. New NACHA rules, speed bump holds, safe harbor immunity, and AI monitoring systems mean that routine transactions are being delayed, blocked, and reviewed at a scale that did not exist 2 years ago. On the other side, the IRS has more tools, more funding, and more automation to freeze accounts for tax collection. And in the middle, consumers who have done nothing wrong are losing access to their own money. This is not a theoretical risk. In 2024, approximately 85,000 Americans were locked out of their savings accounts, with over $100 million effectively frozen, after a fintech middleware provider experienced technical problems. The bank said the money existed. The customer said they could not access it. Some waited months. That was a technical failure. What is happening in 2026 is by design. Now, to be fair, these rules exist for a reason. Elder financial fraud costs Americans billions of dollars a year. Authorized push payment scams, where victims are tricked into voluntarily sending money to criminals, are soaring. Banks were under enormous pressure to act. And the NACHA rules are genuinely designed to catch fraud before it happens, rather than after the money is gone. Recovery rates on fraudulent transfers are historically terrible. Once the money leaves, it rarely comes back. So the intent behind these changes is protective. The problem is the execution. Financial institutions showing ongoing negligence and fraud monitoring could face fines or reputational damage under the new NACHA rules. That creates a powerful incentive. Freeze more, not less. Every transaction that gets through and turns out to be fraud is a potential regulatory penalty. Every legitimate transaction that gets frozen is just a customer inconvenience. The compliance math is simple. Systems are calibrated to overflag, not underflag. And there is another risk that most people are not thinking about: joint accounts. If you have a joint account with a family member, a spouse, an adult child, an elderly parent, and that other person has outstanding debts, creditors can freeze the entire account to satisfy a judgment against them. Because both names are on the account, the entire balance is considered fair game. With consumer debt defaults rising, this creates a massive vulnerability. If your adult child gets sued, or your spouse falls behind on a loan, or a joint holder defaults on credit card debt, a creditor can freeze your joint account to collect. Your Social Security deposits, your savings, your emergency fund, all of it frozen. Not because of anything you did, because of someone else's debt. Untangling your money from someone else's obligation can take months of legal work. When AI systems are making decisions about whether you can access your own money, with no human review, no guaranteed appeal process, and no fixed timeline for resolution, the system is not protecting people, it is trapping them. And the people hit hardest are the ones who can least afford it. Seniors on fixed incomes, small business owners who need to make payroll, families dealing with emergencies who need cash now, not in 5 business days. Small business owners are feeling this acutely. Transfers over $600 tied to payroll, vendor payments, or client invoices are being flagged if they differ from past patterns. For a new business without a long transaction history, almost every payment looks unusual to the algorithm. A first-month payroll run can trigger a review. A one-time vendor payment can trigger a hold. And each delay can mean a missed deadline, an angry client, or an employee who does not get paid on time. The peer-to-peer payment apps are affected too. Zelle, which is built directly into most major bank apps, now has mandatory cool-down periods for new recipients. If you add someone new to your Zelle list and try to send them money, the bank may restrict the first transfer and hold the rest for 24 to 48 hours. Even moving money between your own accounts at different banks can trigger a flag. If you open a new high-yield savings account and transfer a large lump sum from your checking account, the system may treat it as a suspicious outflow. Your money, your account's flagged anyway, so what should you actually do? First, notify your bank before any large or unusual transfer. Call ahead. Tell them the amount, the recipient, and the purpose. A 30-second phone call can prevent a 5-day freeze. Second, keep your information current. Banks are auditing older accounts for missing documentation. Update your photo ID, address, and contact information proactively before the system flags you. Third, maintain consistent patterns. The AI compares every transaction to your history. If you normally send $500 a month and suddenly send $5,000, the system flags it. Gradual changes are less likely to trigger a review. Fourth, have a cash buffer outside the banking system. Financial advisors are now recommending what they call a cash bridge. 1 to 2 weeks of living expenses in physical cash in a secure location. If your digital accounts are frozen for any reason, that cash bridge keeps you operational until the hold is resolved. Fifth, if you owe taxes, do not ignore IRS notices. The progression from letter to levy is predictable and preventable. Responding to the first notice, even if you cannot pay in full, can stop the freeze before it starts. The IRS offers installment plans, hardship relief, and other options, but only if you engage before the final notice goes out. The banking system in 2026 is faster, smarter, and more automated than ever. It catches more fraud, it stops more scams, but it also freezes more legitimate transactions. It locks more people out of their own money, and it does all of this with less human oversight than at any point in history. The money in your bank account is legally yours, but accessing it now requires navigating a system that assumes, by default, that every unusual transaction is suspicious until proven otherwise. That is the new reality. Now, this channel will continue tracking banking rule changes, IRS enforcement updates, and consumer protection developments. If something changes, better or worse, the update will be here. But most people will not see that update. They are not subscribed. They will find out after the fact, after their account is already frozen. If you learned something from this video that you did not know before, hit subscribe. It is free. It takes 1 second. And it means the next time something changes, you hear about it while there is still time to act. See you in the next one.